Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Steve Wyett, Chief Investment Strategist at BOK Financial, as well as Steve Sosnick, Chief Strategist at Interactive Brokers. And we're here to discuss which potential policy changes will have the most impact and the self-fulfilling nature of momentum trends. Steve, it is great to see the both of you. And Steve Wyett, I'm going to kick it off with you. We have a lot to cover, and we are finally here for our last segment of 2024. And the topics that are being generated are just so far wide-ranging. I think part of that is because, one, how much momentum is there still in the market, but we still don't know what policies are going to be in place once we go through the administration transition in the first 100 days in terms of how they're benchmarked.
Yeah, that's right, Jill. And hey, good afternoon. And Steve, great to see you as well. Look, we knew coming into this election, we actually talked about it before the election in one of our previous conversations, the potential for just a huge shift on a number of policy fronts. And, if you think about how the election went down with President-elect Trump, the Republicans took the Senate. That was kind of expected, but they also took the House, which was less than expected. And so a Republican sweep that probably increases the chances for the number of policies that can be implemented. And there's some good and there's some bad there, Jill. I mean, I say bad. I think there's some things that we need to be cautious about. The reaction to the markets, pretty much risk on across the equity markets. You saw credit spreads narrow. You see Bitcoin at 100,000 now. So flirting with that area. So clearly a risk on type of a move. And to your point, now it's going to come down to the implementation of these policies. Tax and regulatory could be very positive. But when we think about that, probably the number one issue that I'm getting questions on as I go out and make presentations on is going to be the impact of tariffs and what that may do to inflation, what that may do to economic growth. But I think immigration and visa reform are going to be just as important from that standpoint as we think about changes to the labor force and how that flows into economic growth and so many other issues. And then energy policy, which, I think we're going to be back to, trying to increase production, domestic production. Energy, I think, has been the worst performing sector in the market since the election. So great for consumers. Not necessarily sure that's great for the energy business. But as you stated, we've already made some moves in the market that this is going to be better, that growth is going to be a little bit faster. The Fed's talking about, economic growth being fast enough that now they can slow down on some of their policy moves. And certainly the market is pricing out a number of cuts as we get into 2025 and raising the terminal rate, which I think that's a really big deal as we think about capital markets, how we price that, the cost of debt as we move forward. And so it really probably puts 2025, it makes it a little bit a bigger question mark just because of the activity that we pull forward or the performance that we pull forward.
Well, Steve Sosnick, it's interesting, and I mentioned this to you last week while we were in studio together. I was in Asia during the U.S. elections, and the results that when the polls closed that came in Wednesday afternoon at 1 o'clock Singapore time, right? It was almost a collective sigh of relief. And the market has not looked back because it was a definitive decision. We knew a concession was coming. Now it's time to move on was essentially the mood that was expressed there for regardless of who got in, the fact that it was definitive. And a lot of momentum has been created as a result of. So I guess the more near term question is, does that continue outside of seasonality? I mean, I heard this morning the high in the street for S&P estimate 1 year out is 7,100. That's a lot to move from here.
Indeed, Jill. That's certainly a big haul. But right now, the momentum is basically a freight train. Nobody really wants to get in the way of it. And as you mentioned, seasonality is very favorable right now, partially because there's really not much on the horizon other than CPI this week and the Fed meeting on the 18th. Beyond that, there's really not much there to impede Santa and his sleigh, coming down for the rest of the year. The momentum is extraordinarily positive. And right now, going into what you and Steve were saying about the politics of it all, there's a real honeymoon period here because you were talking about the first 100 days. We don't even have day one until, for another 6 weeks. And so some of the stuff that they're talking, that can be done with executive orders on day one include tariffs. Now, think of the example of how the market reacted to the threat of tariffs on Canada. Now, Trump, President-elect, President Trump, I don't know how to refer to him right now exactly, but he's long since threatened China and Mexico with tariffs. He threw Canada in there. Now it got Justin Trudeau down to Mar-a-Lago in a heartbeat, and the market interpreted that as a negotiating ploy. But we don't really know what's intended until January 20th, by the way, which is a market holiday, Martin Luther King Day, or January 21st. And so I think right now you can interpret anything in a positive light, but Steve outlined a lot of the question marks that we have to wrestle with, any of which could cause volatility, any of which could impede the momentum. But right now, that's the trend is your friend, so to speak.
Yeah. And you know what else is so interesting? Steve Sosnick, and I believe we spoke about this as well. The expectation for Trump's first term was significant volatility in the marketplace. I mean, there essentially was none. I mean, the S&P was trading in 3 to 5 handle ranges for I don't know how many months. And then December 2018, when you started talking about the tariffs with China and potentially a trade war and so forth, that was when, you started to see the fireworks in terms of getting some volatility back in the market. Other than that, it was relatively muted.
Indeed. I mean, it's interesting because for someone who can be perceived as personally quite volatile, there was very little market volatility. And this, still, I was interviewed recently about, do you dread the tweets that could come out at any hour of the day and night? And to some extent, yes, because you didn't get that in other administrations. You did get that during the first Trump administration. And if this period is any indication, we'll probably get more of them. But yet I do think he is concerned about the market's reaction to him, what the message of the market is. And so that mitigates against some of the more damaging things, at least again, until we start to see, that can be the assumption until we start to see the actual policies come down the pipe.
Yeah. And Steve, Wyett, you and I are both shaking our heads in the background because I think one thing with President-elect President Trump, his major benchmarks are how well the economy and the market is doing. And he's been explicit about that. I would say more so than any other benchmark he'd be measured on. But when you think about when we go into fourth quarter earnings, which takes place in first quarter, and there's expectations that you'll get some sort of annual guidance there, it's going to be a challenge for companies as well because you don't know what the operating environment is going to look like. I mean, it's all conjecture up until this point.
Yeah, I think that's right. And Jill, I do want to add to kind of something that Steve Sosnick was talking about when it comes down to tariffs. And here's what I would say. The way that President-elect Trump is acting now between the time of the election and when he's going to be installed as the president, completely different this time than it was before. He's much more clear on what his administration is going to look like, what his policies are going to be. I'm convinced when he won in 2016, there was a bit of surprise on his part. He had to completely thought through a lot of that stuff. He clearly has thought this through, and you are correct. The stock market is a key aspect for him, and so the tariff statements around Mexico and Canada. I do think those were probably a little more negotiating tools, but here's how you make a negotiating tool effective? Be willing to do it. And that's what he proved in his first administration is he's willing to take these actions. And so it's been, I don't want to say surprising to us, but a bit eye-opening, just the amount of movement that is happening before he even gets sworn in as the president of the United States. There are big things that are happening. I think that when it comes to companies and their earnings, look, here's the other thing we've started to see. The sentiment numbers are improving. So I think companies will probably give the benefit of the doubt to economic growth as we move into 2025. But you're right. There's just so many, you got to break down companies. And so how much business are they doing with Mexico, Canada, China? Where are their suppliers? What could that do to their cost structure? What sectors do immigration play a big part in, whether that's agriculture or construction? It introduces some big variations from a company standpoint, and I do think companies are going to have to start revealing or discussing some of that. but the sentiment numbers just show I think they're going to get the benefit of the doubt that they expect growth to be better next year.
Steve Sosnick, you wrote something really interesting in your December 4th piece, and it says, quote, remember, equity investors usually have a difficult time assessing geopolitical risks unless they directly affect things like revenue, earnings, cash flows, et cetera, right? So we saw what happened with South Korea last week. I think it was, I forget the exact date, but it was Wednesday or Tuesday or Wednesday. The point is, we're not talking about that now, right? I mean, it was on no one's dance card. It was a hot thing for maybe 24 hours. I haven't even heard about it over the weekend or in today's news. So I thought that was a very poignant point that you made in your write-up, because it really, unless there's some direct fundamental impact, geopolitics largely seem, the market's climbing that wall of worry as it relates to geopolitics.
Equity investors are extraordinarily good at ignoring geopolitics, unless, as I said, unless it really affects them. So the South Korea situation, while it's got to be chaos in South Korea, and it's ongoing. They tried to impeach him, it didn't work. They're trying again to impeach him. It was actually, buried somewhere in the news today, but it's not relevant to the market. Unless you're trading, Korean stocks or something that's priced in Korea, in South Korean won. The situation in Syria. I mean, the Middle East is always a powder keg, but bottom line, Syria doesn't produce oil, so nobody's really giving it any market impact. And so these are the things that don't, markets really only care when it affects them. So yeah, you see the treasury bond market did have a bit of a bid, a little bit of a flight to safety bid when the South Korea stuff happened. It's not really reacting to the latest goings on, in Syria and that nature. And again, oil reacts because oil's very, very much a globally traded commodity. And I'll leave that to Steve because he's based in the oil patch and his bank does a lot more energy work than I do. But oil reacts, bonds to some extent react, stocks are the last to react. Again, unless if you're Samsung, LG, something of that nature, they're going to react to what's going on in South Korea. But how that affects Meta, Tesla, it doesn't really in the short term.
Yeah. Well, Steve, Wyett, let's talk more about that. The energy space, the segment before you was on uranium, copper, rare earth materials, because of the demand that AI and other emerging forms of technology is going to have on the grid. And never mind that, but even think about the trades. If you're an electrician, HVAC, these data centers require all of those technical skills. I'm kind of surprised there hasn't been, never mind just natural gas and regular crude, but there's more to that in the energy space. And I'm surprised we haven't seen more of a movement around that. The energy has to come from somewhere. You could develop all the products you want, but if you can't get from A to B or leverage them, it's no bueno.
Yeah, it's a key area as we look. One of the big trends that we're looking at within the economy as we move forward is just the increase in energy demand. And ultimately, this is where it kind of runs headlong into the energy transition away from fossil fuels to green energy. The bottom line is this: we're going to have trouble doing that transition if energy demand stays stable. We're looking at energy demand that's going to be increasing for exactly the reason you say, particularly electricity demand. And Jill, there's some really broad implications there to our grid, modernizing our grid, the generation, the distribution, the storage of energy. Bottom line is this: we think it's going to be an all of the above. It's going to have to be an all of the above type of a transition. Nuclear is going to have to start playing a much bigger part. That's where uranium and some of the other metals come into play there. There's just no way that we can meet these future energy demands unless it's all of it. I think our new Treasury Secretary, Scott Bessent, what has he said? 3-3-3. So 3% budget deficit, 3% real GDP growth, and 3 million more barrels of oil a day. So all of that kind of encompasses where we think we need to be from an economic standpoint, but particularly from energy. We're not getting away from fossil fuels anytime soon. The deregulation, a big part of President-elect Trump's platform. We think particularly LNG could be a big winner there. Globalization of the natural gas market. We've got all the natural gas we know what to do with. So if we that's an area where we could probably benefit from a globalization of that. But it's a big trend, and the dollars are going to be huge on what this means from an infrastructure investment standpoint. It is not going to be cheap to get to where we need to be, both from an AI, but just think about electrification of our transportation network and all the other things that we want to do. It is not going to be cheap to get there.
All right. Appreciate both of your insights as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at